Good morning, dear friends. We have been doing the income from house property. Under this topic, we have already discussed the various concepts which are required to be understood for the purpose of charging the income under this head. We have also discussed the conditions which must be satisfied or which must be complied with for charging any income under this head, that is the income from house property. In earlier discussions, we also learned who are the owners of the property, who are the deemed owners of the property. Similarly, we also discussed the unique cases, some of the cases which can also invoke section 22, that is the charging section of this topic, is income from house property. It means under the unique cases, they are also chargeable under this head, section 22. Now, today we are just going to discuss a very important concept, that is the valuation or the determination of annual value. As I just discussed in the very first lecture, that the annual value of the property is going to form the basis for charging income under this head of income from house property. So annual value is a very important concept because it is the basis of charge of income under this head. Annual value of the property cannot be construed as merely the amount of rent which is received by the owner of the property. Nor can we relate this annual value as a municipal value of the property which is determined by the municipal corporation for the purpose of levy of house tax. In fact, the annual value of the property is the sum for which a property might reasonably be let out from year to year basis. So, you can say the annual value is some notional value or it's an imaginary value for which the property can be let out on year to year basis based on some prevailing conditions. For example, the type of construction which that particular building or house has got, the prevailing rent around in the locality, the demand and supply of the houses in a particular locality, and the type of house which is subject to rent. So these are the conditions. Which may prevail for determining the annual rent. Certainly, it should not be confused with that. The annual rent should not be confused that it is the actual rent which a person might receive. That would be deemed to be the annual rent, annual value. Certainly, it is not the case. For determination of the annual value of the property, we need to understand some concepts relating to that, which is based on certain other values, certain other concepts. Before we just understand the various concepts under it, I just want to tell you, for the purpose of ascertaining the annual value of any house property, annual value of the property, first of all, you should be clear. We should ascertain whether the property is going to be let out by the owner or it is going to be occupied by himself. It means the basis of calculations are different. If the property is subject to let out, the calculation is different. The concepts are, means the procedure is different for determination of annual value, and if it is to be occupied by the owner of the house, then the concepts or the procedure is different. So we will have to ascertain whether the property is let out or it is self-occupied by the assessee himself, because in both the cases the determination of annual value will be different. So that is not uniform in both the cases, because ultimately there can be those two situations only. First situation is the property which is let out, and the other situation may be the property which is self-occupied or by the assessee himself. So in determining the annual value, the following factors they are required to be understood because they have got a lot of bearing for the purpose of valuation of annual value, for the purpose of determination of annual value. The first important factor which needs to be understood is the municipal value. Municipal value is a value which is determined by the municipal corporation for the purpose of levy of tax on the house, and which may be in the form of house tax. So this valuation may be done by the municipal authorities. So we'll just call it as a municipal value. The next is a fair rental value of the property. The fair rental value of the property means that what a similar property may fetch in the market. So that would be the fair value of the property. For example, if a person A is holding property, some property in locality X, and similar property which is just similar type of property which is just being owned by A, it fetches certain rent, then we can say that the property shall have a fair rental value of this. It means the rent which is similar property can fetch in the market, that is called the fair rental value. The third important concept or factor which is required to be known is the standard rent. The Rent Control Act fixes the standard rent. If the rent is fixed under the Rent Control Act, then naturally the owner of the property is not expected to get the higher return than the standard rent. It means if the standard rent is there, is fixed, naturally the owner of the property is not expected to get more than the standard rent. It means the actual rent would be either equal to this or it would be less than that. So this is also a very important concept because this standard rent is fixed under the Rent Control Act. So this is called a standard rent. So three factors we have understood, we have discussed. Number one is the municipal value, number two is the fair rent of the property, and number three is the standard rent, because this is also very important, the standard rent. And the last factor which needs to be understood is the actual rent received or receivable. So these are the four factors on which the annual value of the property shall be based, and we'll be discussing this in detail in our subsequent subsequent discussion. So these are the four things. I just want to stress upon these four things again, because these are going to form the basis for calculation or the determination of the annual value of the property. The first is your municipal value. Municipal value means the value which is determined by municipal authorities. The second is the fair rent. Fair rent means the rent which a similar property can fetch in the market. So that is called a fair rent. The third is the standard rent, and the standard rent is the rent which is fixed under the Rent Control Act. And the fourth is the actual rent received or receivable. So these are the four variables based on which we shall determine the annual value of the property. We are just talking about the annual value in the case of let out property. I just told you earlier also, because the methods are different for the valuation of annual value. The method is different for the let out property, and the method for valuation of the annual value is different if the property is being owned by the owner of the property by himself. So now what exactly is the procedure? The procedure of determining the annual value is confined to the four steps. It means there are four steps. Four steps are involved for determination of annual value. And these four steps are interconnected, they are interrelated. So what exactly are those four steps? We'll just try to discuss. First step is that always the first step for the calculation of annual value of the property is calculate. First of all, you determine the municipal value. What is the municipal value of the house? Then you see the fair rental value. Fair value. It means, I just told you earlier also, these four important factors are going to give you the base for determination of annual value. So municipal value, first of all, try to get the municipal value of the house property. What exactly is the municipal value? Then get the fair rental value of the property. Fair rental value means that rental value which the similar property can fetch in the market. That's not a fair rental value. So you just compare both the values and take higher. Whichever is higher, it will form the basis for step 1. It means if municipal value is higher than the fair rental value, then this value should be taken. If the fair rental value is higher than the municipal value, then we'll take fair rental value. It means we'll have to take higher of these two. Higher of these two. This is a very, very important step. This is the beginning of the calculation of the annual value of the property. So, in the first step, we'll have to determine which value is higher. Means between these two values, we'll have to take the higher. The second step, the step 2, is once you have taken, this is step number 1. I can put it A, I can put it B, A or B, whichever is higher. Now, step 2 is this higher value you have taken. Now, you compare this higher value, this value with the standard rent. Compare the value of step 1 with standard value. So, whatever higher of these two values you have taken, you compare this with the standard value. If the standard value is less than this, it means by comparing, you will have to take the lower of these two. Here, for example, in this case, the fair rental value was taken, that was a higher. You just compare this value with the standard rent, and whichever is low, that would be carried forward for third step, which is called third step. It means if in the first step the municipal value is greater than the fair value, we'll be taking municipal value. Then we'll be comparing this municipal value with the standard value. Ultimately, whichever value is less, if the municipal value is less, we'll be taking municipal value. If standard value is less, we'll be taking standard value. So the comparison would be in respect of higher of it and the standard value. So that would be taken, means lower than these two would be taken. The next step is step number 3. You can say whatever value is taken, you can also take, you can say as expected value. This is called expected value, you can say. What value is expected? Certainly this value shall not be more than the standard value. It means this value, expected value in step 2, because whatever value is taken, that would be called expected value. In no case, this expected value would be more than the standard value. Certainly, it would definitely be less than the standard value, because we are just taking lower of these two values. The third step is, this is very, very important step. Third step is, from the value so arrived at, now this expected value you have arrived at, from this value you will reduce the loss of rent due to vacancy. It means if you have given your house on rent, you have let out your rent for say for 12 months, and out of this 12 months, 3 months there was no tenant. It means your house was lying vacant for 3 months. So you will have to reduce this loss of rent due to vacancy, because the house was vacant for 3 months. So you will have to determine, you will have to reduce the loss of rent due to vacancy from this expected value in step 3. So that is called step 3. So in step 3, only the loss of rent due to vacancy is to be reduced from this expected value, and whatever value it comes, it will form the basis for step 4. Now what is the step 4? Step 4 says whatever value you have got after having made the deduction in respect of loss of rent due to vacancy. Now whatever value has come, you compare this value with the actual rent received or receivable. Means you just compare this with the actual rent received and take higher of it this is the way we can calculate it. Means I just try to explain it. Step 1, higher of municipal value or expected value or fair rental value. Higher of these two. Step number 2, calculate, compare this value, compare the aforesaid value with standard rent and take the lower one. Whatever value comes, it is called the expected rent. Now, step number 3, from this expected rent, reduce what? The loss of rent due to vacancy is loss of rent due to vacancy. Now, whatever value it comes, step number 4, value at step number 3, means compare this value at step number 3 with actual rent received or receivable, and take the higher of these two. Take the higher of the two. So this is the way the annual value of the property is calculated. This is a very, very important thing because it is going to form the basis for the various questions which may be asked in your exam from this particular topic. We just take one example. Say property A is there. This is the property A. Municipal value of the property A is say 1 lakh rupees per annum, and fair rental value of this property is say 1,20,000 per annum, and the standard rent, the rent which has been fixed under the Rent Control Act is say standard rent is say 90,000 rupees per annum. And the actual rent of this house is say at the rate of rupees 9,000 rupees per month. It means 1,08,000 for 1 year per annum. And this is the actual rent, means the landlord is getting actual rent of 9,000 rupees per annum. It means the annual value as per the actual rent would be 1,08,000 per annum. And the house remained vacant during the previous year, say for 1 month. It means the loss of rent for the vacancy was say 9,000. Now these are the particulars which are given. We are required to calculate the annual value of the property. How would we calculate? Step number 1 would be, first of all, what is the hire? This is my step number 1. The hire would be 1,20,000. So I will be taking 1,20,000. That would be the value under step 1. Hire would be 1,20,000. I just compare this hire with the standard rent, which is 90,000. It means this comparison of this with 90,000, I will be taking lower of these two. So the lower would be 90,000. That would be the value. It is my expected value is 90,000 rupees. Now I will have third step is, let this value be compared. Let this value be reduced by the loss of rent due to vacancy. The loss of rent is 9,000 rupees. It means under step number 3, the value would be 81,000. Now compare this value with the actual rent received and receivable by the landlord. The actual rent received is 1,08,000 minus 9,000. It means 99,000 rupees. This is the actual rent which has been received by the landlord. I just compare this value with this, and I will just take higher of these two. So the annual value of house property would be 99,000. So that would be, this is the way we can calculate the annual value of the property. We'll just try to understand this concept with 1 or 2 more examples in our subsequent discussions. Thank you very much.